So this is a continuation of our training on self-insurance and level-funded health plans. And move on to the selling tips and selling aspects of these types of plans. Pause here for a moment on this slide that was the Self-Insurance 101, the basics, and just have your eyes and your brain reconnect on some of the points indicated here on this screen about the fixed cost and stop loss insurance and claims, etc., mature versus immature, because all of these will be relevant as we discuss selling these types of programs and the run out terms. When we talk about employer opportunities versus risks, again, as your eyes are looking at this screen in terms of the different opportunities associated with going into a level funded and self-insured type program, but also some risks associated with that. So again, keep these things in mind because you need the technical knowledge to be able to then sell features and benefits, pros and cons of anything. And so that's what we'll move into now, the selling aspect of these programs. So let's start with what makes for a good candidate for these types of programs versus what makes for maybe a bad candidate or someone that maybe at this point in time is not somebody that should be considering self-insurance or level funded plans. So who's a good candidate? So most important, right up front, it's literally the mindset of the company decision maker, the owner, the chief financial officer, the head of HR, whomever is making this decision. The mindset matters a lot. They've got to be willing, they've got to be of the frame of mind to want to buy differently. They just want a different way to buy. I go back to the 80s when I was at Prudential Health Insurance and Pru and Met and Travelers and Chubb and John Hancock and Guardian and Lincoln National and you name it. And all of the big carriers, of course, Blue Cross, all the big carriers were in health insurance. And back then, we were still having the same conversation then that we have today. Hey, bad news, carrier wants a 15, 16% increase. Good news, I'm such a great broker, I got it down to 7 or 8 or 9%, single digits, right? Well, that's been the talk track forever, and it's been frustrating for employers forever. And so back in the 80s, leading into the 90s, the different way to buy back then were these new things called HMOs or PPOs or point of service plans, these network-based plans. Well, today we all see this as the norm. This is the traditional way to have benefits today. But for those of us that go back to, the 80s and 90s, we know that was not always the case. So back then, the employers that moved into HMOs and PPOs and these managed care type programs, they wanted a different way to buy versus just major medical over Blue Cross Blue Shield, traditional indemnity health insurance. They wanted a different way to buy. They were frustrated with the then broken system of traditional indemnity insurance, and they saw these network-based plans as the opportunity to buy differently and possibly, hopefully, have a better outcome. And so obviously the world changed, and the Prus and the Mets and the Travelers of the world got out of the business, and these HMOs and managed care companies took over, and big mergers occurred that ultimately created United Health Group. Aetna bought a bunch of HMOs and kept the Aetna name, but they transformed themselves through purchases of HMOs. The Mets and the Prus and the Travelers of the world got out of the business. The point of this is, first and foremost, when you're dealing with a prospect, they want to buy differently. They can't be entering this thinking, this is just a commodity. I'm just doing the same thing that I've always done, and I'm going to expect a different outcome. They want a different way to buy. They're frustrated with the current system. They're open-minded. They're not only able to be, they're willing to be taught a better way. And that's why it's incumbent upon us to be technically proficient in these programs so that we can explain and guide them as to how this is different and will put them in a position to have a better outcome for both their company financially as well as for their employees. The other thing is, we want a buyer that's not necessarily tied to name brand, right? The big four, Blue Cross, United, Aetna, Cigna. Yes, you can get self-insured plans administered by them. Yes, you can get level funded plans from them, but it is still being provided by the same entities that are really a big part of the problem in health insurance today. They are the ones that dominate. They're bureaucratic. They are heavily expensed, either publicly traded or with high salaries at the executive level and lots of bloat in those big companies. And so, yes, they still have the asset advantage of their name, but that has, as we've all seen over the years, those brands are no longer as well respected or as well desired as they once were. But they still have some leverage with their name brand. So the buyer has to be open-minded to look at TPAs, third-party administrators, and reinsurance carrier models like we've been talking about outside of the traditional carriers. It's also helpful if they understand the workers' comp dividend plans, right? So we're talking health insurance here today, right? So why am I bringing up workers' comp? Because many employers, they get it in terms of cost containment, claims management, risk mitigation when you talk to them about workers' comp. You walk by a construction site and you see signs that say 37 days or 337 days of injury-free, no accidents. That's promoting a safe workplace, right? And so they get the concept of if we create a safer environment, a lower claims environment, they will have lower workers' comp exposure. And then in a workers' comp dividend plan, they simply get money back at the end of the year. If their workers' comp plan ran well, they get unspent claim dollars back to them. Same that I've been promoting here with level funded plans. Claims run well. We do an accounting at the end of the year, and depending upon what type of program the employer is in that you've put them in, they're either going to get 50 cents of any unspent claim dollar back, or they're going to get 100% of any unspent claim dollar back, such as in the Premier Health programs, we give 100% back. So that's the mindset, the most important thing when you're thinking through who's a good prospect, who's a good candidate for these types of programs. Beyond the mindset, of course, there's the facts and circumstances surrounding the group itself. So based on the census, do I have a high average age? Or if I don't have a high average age, do I have a young female population, right? So obviously that has different claim risk as young females versus young males in terms of pregnancy or not, right? So the demographics of a group, or do I have older males, which would tend to be higher risk than older females, right? And so there's a whole evaluation that goes based upon the census. And as I put there, other available data. Do we have access to current claims reports? Is this employer provided claims reports from their current provider? And if so, what does that tell us? What does that tell the underwriter about how the group is running? I put on here Gradient AI. Some of you or all of you may be familiar with this company. There's others like them out there, but they're the preeminent one that uses artificial intelligence to take a census. They then go out into the public records across all the internet, and they can find information on, say, myself, Jim O'Connor. And if they put in my name and date of birth and zip code, they would find in the public records what prescription drugs I'm on. Have I had any lab work done? Have I had any MRIs? All of this is out there in the public domain, and they can scrub all of that data and quickly as determine if Jim O'Connor has any ongoing medical conditions as indicated by prescriptions I might be on or recent tests or surgeries I may have had. So evaluation of the group, personal health questionnaires. I know that these can be problematic and cumbersome and real pain in the neck in the larger group market once you get up into 20, 30, 40, 50 employees. But if you're playing down in that smaller employer market, say under 10 or under 15 or under 20, a PHQ could be another way to evaluate the risk inside of a group. Now, again, when the employer says this is too much of a pain in the neck, I don't want to do this, this is really too much to ask, let's go back to the mindset. Do they want to know if they're a good candidate from a risk exposure perspective to consider going away from the fully insured complete risk transfer type product of regular health insurance and come into a program where they're going to participate in the program? So if they're unwilling or really antagonistic towards assessing their group to see if they would be a good candidate, whether it be from getting a dependent level census or all the other evaluation that we could do, then maybe they're really not a candidate for it. I'm not suggesting that just because a 30 or 40 or 50 or 60 life group doesn't want to do PHQs, that makes them disinterested and disengaged or of a negative mindset. I get it. Like that is PHQs and that level of size company is problematic. But we want a mindset of a person wanting to not go into something blind. And so if we're not in a PHQ environment, but we're using the dependent level census and the gradient AI is able to reveal for us what does it tell us about the risk, forward-looking risk aspect of this group. That's the crystal ball, right? That's a crystal ball that tells us, do we expect this group to be average or better than average? And if so, then let's move forward in this consideration. So who's a good candidate? A lot about the mindset, a lot about what they're willing to do and how they want to engage in order to buy differently. So as your eyes have scanned over, who's a bad candidate? Some of this is just so self-evident, right? I mean, it doesn't really take a lot of teaching to know that if a group has known ongoing large claimants, then they should not go into a participating contract, a self-insured level funded contract, because it would be unlikely that they will participate in positive claims outcomes at the end of the year. So there are certain groups in all types of insurance where you either want to retain risk or transfer risk. I have 3 teenage daughters driving. I would never want to be self-insured, with them driving our cars. So it's all about risk exposure and how much do you retain versus shift. So that's all they're talking about here in terms of insurance and now health insurance. If it's an older group, being of the older generation myself, I'm healthy, God willing, knock wood. But the underwriter actuarial tables will tell you that an older group would tend to be higher risk exposure. So maybe not an automatic knockout, but maybe this would be an indication to be cautious and maybe not go into a self-insured program. If the buyer is completely focused on name brand. Now, as I said earlier, you can get self-insurance and level funded plans from the carriers. So again, this is not a complete knockout, but if they are just literally about brand to brand, and they really don't see this as anything other than just buying the same way they always have and looking for a different outcome, then I would be cautious about that as a candidate. Real importantly, are they indifferent or even worse, unwilling to engage their employees? And we'll get into this later, but the indifference or unwillingness to engage their employees and making them a part of the solution, right? If they really just don't care, they are too busy, employees will never get it. We all know the excuses why some employers tend to not engage their employees when it comes to benefits. The mindset, right? We all know that most employers are angry at the current health insurance system. I use that word system loosely, but the health insurance environment here in our country, everybody's angry. If you're angry and you've got a positive mindset, you're going to convert that anger, that frustration into positive action to do something differently. But we all know there's many employers, or a fair number, that are just the angry victim, right? They just think it'll never change. This is always going to be a problem. And everyone else is to blame. It's the damn insurance companies, it's the hospitals, it's the doctors, it's the lawyers, it's the government, right? So they don't see themselves as having a seat at the table for positive change. And so that person, that employer, is probably not of the right mindset to engage differently, because they want everybody else to solve their problem and they don't want to be part of the solution. So continuing with the selling tips, what to emphasize, right? We all have been taught selling benefits versus features. You have to know the features and sell the benefits of those features. So what to emphasize? Obviously, the ability to get money back at year end, right? Like first and foremost, you're in a fully insured plan. It's just dump money in and you'll never get anything back. You've transferred the entire risk over to the insurance carrier. So if your plan ran well, they win. If your plan ran poorly, they may lose in the short term, but you'll make up for it on the renewal. But you do not participate in any type of year-end money back if your claims ran well. So you want to emphasize, hey, You can get money back at the end of the year if things go well. Emphasize that they will get regular claims reports. Different vendors will provide reports on different frequency. Again, the carriers are less transparent in their reporting. However, TPAs are more transparent, and some are more transparent than others. In our program, we happen to give monthly claim reports to a group of 10 or 15 or 20, the same as we would give to a group of 500. Now, one can tell you from a data perspective, right? Some of that is overkill, so not really predictive at all times, and sometimes there might be no claims. But I think it's a cultural mindset, business cultural thing that we say to these folks, this is your data. We're not giving HIPAA protected data, but we're giving real financial data that a company owner or CFO can be looking at and we can be discussing with them. And so they appreciate that this is not a hide the pee under the cup kind of thing. This is really your money that we're showing you, just like you would in any other financial program. And with that, you have the ability to influence claims. I'm not going to say, control or anything stronger than influence. So how does one influence claims? Well, from that claims report, if you see over a period of time, that there's a high degree of brand drugs versus generic, low mail order participation. These are things we've been talking about for decades, but we continue to have to talk about them. A high use of emergency rooms for non-emergency situations, low telehealth utilization, etc. This gives us education opportunities, communication training opportunities to our employees, always reminding them that they have the ability to have an impact, have an influence on this journey as it relates to the cost of our insurance, and that'll influence our renewal next year and what we take out of your paycheck, ladies and gentlemen. So we've got to engage everybody equally, and I would submit to you more importantly, ability to influence claims, care navigation, steerage, place of service matters. Say time and time again, particularly as hospitals buy up orthopedic practices, and then they're doing that. They want to be able to steer. They want to control where tests get done, like MRIs. Now, if you're going into a hospital for that elective MRI, right, elective being you're scheduling a surgery in the future, so this is not an emergency, but elective, they direct me into the hospital, and I get a $4,000 MRI. If I had gone to the freestanding facility down the street at the mall, it'd be $800. Same quality, maybe even better quality, right? So place of service matters. When you are in a fully insured plan, you really get no benefit from that, right? When you are in a self-insured or level funded plan, and if you had people in your group that got 6, 7, 8, 9, 10 MRIs over the course of a year, and that's at $4,000 a clip versus $800, what a big difference in terms of cost of your program. So think about this now, right? Then at the end of the year, when you get money back, you can share that with your employees. And this is you selling the employer, talking to them about what buying differently looks like, and then what the management and journey of the health plan can look like, and then what the outcome can look like by engaging their employees, making them a part of the solution, making them aware that they can have an impact. Now, at the end of the year, you get money back. Ladies and gentlemen, guess what? We had such a good year last year. We got money back. No payroll deduction for the next 2 or 3 months. Think about the employee's reaction to that. And this is how you should be talking to the employer. This is what buying differently looks and feels like, right? So the ability to influence claims. There's a reason why self-insurance and level funded plans are the fastest growing type of plans in America. Remember the statistic I shared with you on Tuesday. According to the McKinsey Consulting Company's study, McKinsey study of last October, it's the fastest growing type of health plan in America. Over 50% of employers under 50 employees today, under 200 employees today, have self-insured plans. And the number is forecast to just grow by the millions upon millions of people over the next 5 to 8 years. So think about that. As more and more people leave the insured market, we all know about the definition of a death spiral in insurance. It's all about spread of risk across large numbers. But if better risks than average risks, and then maybe even not average, maybe a little worse than average, but as they leave the insurance carrier pool, what's left? Just the worst risks. So that's going to exacerbate the future renewals of the traditional insured plans. So moving into the self-insured plans, the employers are looking to get away from the current broken carrier model. And with that, let's talk about plan design. So you can get standardized plan designs turnkey, right? Particularly in the smaller markets, smaller employer markets, say under 100 employees. This is typically the way it goes, where folks like me and my company or others in the market, the carriers will come out with standardized plan designs in the level funded, in the self-insured space, copay plans, high deductible plans with HSAs. Maybe you have different types of plans that are all off the shelf from the carrier, from the TPA like me. Standardized plan designs makes it real easy, real turnkey. You can also get into customization, greater flexibility when you're self-insured, right? We talked about the other day that you do not have to comply with state mandated benefits when you're self-insured. So if you have a larger employer and we're starting to customize plans, maybe you decide you want to place greater emphasis on mental and nervous coverage or holistic medicine, chiropractic, acupuncture. Maybe you do or don't want to cover weight loss drugs. You have a much greater influence and ability to customize in the larger market. I'm talking about 100 employees and above. And again, this ability, this flexibility to customize is more pronounced when you're with a TPA versus the carriers. The carriers still tend to be more rigid in terms of customization than TPAs will be. As you get very large, 500, 1,000 and above, the carriers clearly will get equally flexible. But if you're in that kind of a few hundred employee market, the carriers tend to still be more rigid and standardized versus the TPA market. To cover or not to cover, I just made reference to weight loss drugs. As this customization discussion continues, I get to decide what I want to cover or not cover. Remember, I'm a self-insured plan. I'm bearing part of the risk, particularly if I'm in a cost plus type model. And so I may decide that I want to cover weight loss drugs or not. I may want to do an HRA, health reimbursement arrangement, as a side way to cover weight loss programs, including the drugs. So again, I'm being repetitive here, but in features of selling to an employer considering self-insurance, level funding, et cetera, as you move up market, you have this greater flexibility, including carve-out opportunities. What do I mean by that? So I think as anybody that sold our program knows, and again, we're not the only ones that do this, but you have the ability to carve out certain high-end, expensive, low-frequency, high-severity type parts of a program. You'll see it happen with kidney dialysis, where you can declare that kidney dialysis is not covered in your program. And then you do what's called a carve-out, where you then contract with a kidney dialysis vendor like DaVita, the largest in the country, and you have a direct contract with them to cover kidney dialysis. So you're giving the person the benefit of being covered for that, but you're carving it out of the insurance plan. You can do the same thing with specialty drugs. Any deeper on this, into the details of how that's done is beyond the scope of this discussion, but just understand that you have these opportunities, and as part of selling to the employer, these are all part of the discussions. Some of these points I'm making are more relevant as you move up market, and some are not. So just remember that it's all part of who is your buyer, who's your prospect, small, mid-sized, large. 3-tier direct contracting. What do I mean here? So again, we do this in our programs. We have a big initiative coming out in the first quarter where we can build 3-tier plan design, direct contracting with hospital systems. We might go into a state like Texas or Georgia or Florida and have a direct contract with a major hospital system in a city or geographic area. And then if an employee member goes to that provider, then it's no cost, no copays, no deductibles, no member cost share at all. The reason is we can get lower pricing, lower reimbursement in a direct partnership with that health system versus what the carriers can do. And hospital systems love to get out from under the insurance carriers. So you're seeing direct contracting growing significantly across the country, and you're going to see it even more so over the next 3 to 5 years on a fast track basis. What does this mean? Well, again, if I'm self-insured, level funded, and again, place of service matters, and now I'm doing a program that's got 3 tiers instead of 2. PPO, we think in and out of network. In-network only HMO plans, you just can go in-network only. PPO, you can go in or out. Now think of this 3rd tier, where I have a direct contract with a hospital system. And if I go and my members go to those folks, they have the best coverage, lowest cost of claims, means a lot for me as I try to lower my cost of care and get money back at the end of the year. But I then still have this middle tier that could be a Cigna network or a PHCS network or some other network. And then you have out of network, which is, of course, traditional deductible coinsurance. So plan design. So the selling tips here are emphasizing about buying differently, engaging in the process. By so doing, you have the ability to get money back at the end of the year. You'll have transparency into how your plan is running. You are joining a member of fastest growing type of employer purchasing of health insurance in the country. So it's not like you're out over your skis doing something that's way new and untested. Self-insurance has been around forever. Level funded plans have now been around for probably at least 20 years. And so this is a proven model for the right buyers that have the right mindset and want to lean in and make a difference. And you've got the flexibility to do different types of things once you go into the self-insured world. Okay. Well, I'm very appreciative of folks joining us today. And as I've said, we'll look forward to doing business with you. And if you have an interest in seeing Premier Health level funded proposals for your clients, we'd be happy to work with you on them. So I wish everybody the best in the fourth quarter. And thanks for joining us for our training sessions.